Welcome to our February presentation of SMSF issues that have come across the desk. And in particular today, I'd like to cover off two issues: the indexation of the transfer balance cap and a suggested cap on total superannuation balances that are able to be retained within the environment. With the release of CPI figures by the Australian Bureau of Statistics in late January, the general transfer balance cap is set to increase from 1.7 million to 1.9 million on the 1st of July 2023. The increase in the transfer balance cap, if it goes ahead, will have a flow-on impact to the ability to make non-concessional contributions and subject to later discussions on this particular issue. The indexation of the transfer balance cap was not touched in the October mini budget that was brought down by Jim Chalmers, but there have been suggestions coming out in the media recently where it may be further considered in the May full budget by Jim Chalmers. This will be quite an interesting issue because, as we know, the general transfer balance cap is indexed by reference to CPI. So in other words, any indexation that's applied purely represents the value in real dollars of the $1.6 million cap that was put in place in 2017. There has been quite a degree of erroneous media commentary about this being a free kick for people to get access to a higher level of concessionally taxed superannuation. But the point again needs to be made that this is merely an indexation based on CPI. We're keeping the real value of the transfer balance cap. The other point that needs to be made here is that existing individuals who have a retirement phase account-based pension will only have an unused cap percentage, which will determine how much, if any, of the increased cap they may have access to. This is an interesting technical issue because there were many people who were forced to commute elements of their account-based pensions on 30 June 2017 to bring them back to the $1.6 million level. These people in general have no unused cap percentage and therefore they cannot take advantage of any future indexation. Interesting one, because these issues are not really discussed accurately in the media. The general presentation is that all pensioners are getting a free kick because of the indexation. This is not the case. The one thing that we also as advisors need to consider in respect to the transfer balance cap, we are somewhat constrained in our capacity to readily get information as to our clients' unused cap percentage, the amount of monies that have been counted towards the transfer balance cap, because of the lack of access to data that we have. And in fact, in my role as an SMSF administrator, I still don't have that access because the client must either go through MyGov or through their tax agent. So I think it's a case of watch this space. It'll be very interesting to see what comments Jim Chalmers makes in the May budget, if any, on this particular issue. The second issue that I'd like to have a look at today is a suggested cap on total superannuation balances. This is a very, very interesting one because we've got the Financial Services Minister, Stephen Jones, who has come out in the press stating that he wants to legislate a statement clarifying the purpose of superannuation. That's great. They've been talking about this for some years, but we're no closer to getting some clarity on that particular statement. But yet he's determined in his comments that he's suggesting that $5 million might be enough. Well, if we don't know what the purpose of superannuation is as defined by legislation or regulation, then I'm at a loss to understand how he can determine that $5 million, an arbitrary figure, might be appropriate for people to have within the superannuation environment. It's quite interesting to note that Care Super, Hester, Aware Super and Australian Super are also reported to be backing a $5 million cap ahead of debates that are obviously happening before the May federal budget. Now, to me, this partly comes down to the politics of envy. I'm at a loss to understand, and I'm certainly not aware of the government's capacity to point to anybody who's developed in excess of $5 million in their superannuation balance, who has not done so legally. If we look at it logically, there are many issues that we take into account. Prior to 2007, there was no cap on capital contributions being able to be made into the superannuation environment. We had RBA certainly that we had to consider, the range of issues that we looked at the time. But in terms of looking at the capacity to contribute, there was no basic cap on capital that went into a superannuation fund. It's an interesting one. If you can show me that there's a degree of illegality with respect to the behaviours of these people who go through an annual audit on their superannuation funds, I'll buy you dinner. Further to this, the Australian Institute of Superannuation Trustees have stated that anybody who has a balance in excess of $5 million should be required to withdraw the excess amount by the 1st of July 2024. Of course, these issues raise a whole series of questions. How much is enough? Where is the government going to draw the line? On every basis, are they drawing the line? What would be the mechanism to withdraw monies? Could a simple solution be to apply a further tax scale on superannuation balances in excess of 5 million? Be interesting to see what they come up with. You've also got complicating issues such as cap defined benefit income streams, which are non-commutable, that may be in excess of the transfer balance cap. And of course, as we well know, that those balances that are in excess of the transfer balance cap, if they're part of a capped defined benefit income stream, are not considered to be in excess. So where do we stand again against the value of $5 million? Is the government going to consider CGT concessions? Because presumably there's going to be a large number of assets that may need to be sold and are going to trigger capital gains. Another issue that I think the government needs to explain is the modelling that Treasury may have done or may be considering doing in respect to the so-called death benefits tax. Because presumably, if someone has more than $5 million in a superannuation fund, the excess over the $5 million at least will be in the accumulation phase. And as we all know, the earnings and growth contribute to the taxable component, which would be subject to a tax rate of 15 to 17% at death of the last of an individual member in an SMSF, for example. We've also got a whole series of issues that there may be some CGT issues applicable to that money that's retained in the accumulation phase. Has the government actually modelled the tax that they would be foregoing by forcing people to take money out of the superannuation environment? This issue is very much an issue to do with the politics of envy. As I say, if you can show me anyone who's illegally gained more than $5 million within the superannuation environment, please show me. Let's take a modicum of sense with respect to the government announcements. The government is going to get a tax take on excess balances at some point of time in the future. It doesn't really, to me, make a lot of sense to apply a $5 million cap, but let's see what happens. This is very much a case of watch this space. And I suspect that we may need to make some very quick actions, both on terms of any loss of indexation of the transfer balance cap prior to 30 June, and on any cap on total superannuation balances that may be applied by the government. This year, unlike last year, I think the May federal budget will be an interesting read. Thanks very much. I look forward to seeing you next month.